What if I told you that there is a way for you to achieve powerful tax-free growth for your retirement and to hand your heirs an extremely friendly legacy asset? Today, it's all about Roth IRAs and why you should be contributing to them, no matter where you are in your working career. Hello, this is Andrew Busa, and I'm a financial planner here at Advisor Investments. We're here with another Advisor You Can Talk To podcast, and today I'm joined by my colleague, Rick Winters. He's a certified financial planner and a vice president here at Advisor Investments, and he works with clients in a relationship capacity.
Hey, Andrew. How you doing?
I'm doing well. Thanks for joining us. So today, it's all about Roth IRAs, and the reason why we want to do this podcast, and this has been on our list for a while, is because the Roth is really an essential financial planning tool for all ages, but the reasons why and the considerations can be pretty drastically different depending on where you are in your life and in your working career. So with that in mind, we're going to frame this podcast as told by three different planning points. And the first planning point will be a 25-year-old with their first high-paying job. The second planning point is going to be a 45-year-old in their peak earnings years. And the third and final planning point will be a 65-year-old that's considering retirement. So you'll see as we go through these that the reasons why considering making Roth contributions is pretty different for all of those planning points.
Yes, they are.
Exactly. So we hope that you take away three things from this podcast. The first is just what Roth IRAs are and why you probably hear so much about them in the media. The second is when they're useful and when they're potentially not, and when you might want to avoid doing some of these more advanced strategies that we'll talk about. And the third and final takeaway will be just to give you a handle on the unique financial planning considerations that come along with these accounts. So first, let's quickly discuss what Roth IRAs are, give you a little history and just why you should care about them. We'll try to keep this section brief.
I'll grab that. So, we'll try to put it in its proper box, but brief, that's tough. We'll see how we do there.
Mm-hmm.
So, first, Roth. What that sounds like some totally purposeful name that describes tax-free.
Mm-hmm.
Well, actually, no, it doesn't. It's named after William Roth,
a senator.
A senator.
Mm-hmm.
Yes, Senator William Roth. Which was established by him by submitting a bill under the Taxpayer Relief Act of 1997.
Okay, so these have been around for a while then.
Yeah, absolutely. First time you were able to save into a Roth IRA would have been 1998.
Okay.
So we're looking at 20 plus years. This is still something that many people need to learn about, though. So they've been around for a while, but not everybody's fully aware of the ins and outs.
Mm-hmm.
So let's focus first on the taxation. They're similar to a traditional IRA, where in that case, the biggest distinction here is you're saving money in an IRA as pre-tax before paying federal and state income tax. Those grow tax deferred, then taxable as normal income when distributed to the owner. And for pre-tax savings, you have a required distribution at 70.5. Mm-hmm. For Roth IRAs, it goes in after tax, grows tax-free, and is distributed tax-free. But there are no RMDs for the primary owner or spouse beneficiary on a Roth IRA.
That's definitely a key point there. So with a Roth IRA, once you put money into this vehicle, it's never taxed again.
That's right.
So that's really a point to highlight.
Or beneficiaries. Now, the beneficiaries, non-spouse, would have required distributions, but that still would be tax-free.
Right. And another key point that you mentioned here with no required minimum distributions for Roth IRAs, the other point to go along with that is there's no age limitation when it comes to if you can contribute to a Roth. What it relies upon is if you have earned income.
Earned income, that's right. And earned income is a statement out there. It's not your dividends, your interest, and your capital gains. This is I went out, I was paid for work I did, you earned it. It comes in the form of salaries and bonuses, wages and commissions and tips. But again, not stuff from passive income, from rental income on your house. So you have to be out there doing something. But you can do this if you're 80 and you're still mowing the lawn and getting paid $10 a week. You could put that in there.
So let's say you have earned income. What are the main ways that you're able to fund a Roth today?
Yeah, there's three main ways to get money into a Roth, which is your traditional contributions through a Roth IRA with your annual limitations, through an employer-sponsored plan, or conversions. Mm-hmm. So conversions would be I have an IRA asset, either in an IRA or a 401k, something I'm at pre-tax status on at this point, and I want to convert that over to a Roth. Now, what's happening there is I'm creating income. And if I'm already in a high tax bracket, well, you're just going to add more income to a very high tax bracket. If I'm in a very low tax bracket, or in maybe even temporarily, I can use that conversion as a way to get some income out of there at a lower tax rate. But can be quite expensive if you don't plan ahead.
And Rick, when you say creating income, remember that this is taking money from a tax bucket that's never been taxed, your traditional IRA, and moving it to a Roth IRA. So since that's never been taxed, the IRS is going to see this as creating income, and it's going to be taxed as ordinary income. And I think that brings up this larger overall point here to keep in mind, is that making a contribution to an IRA can seem like a simple matter of just writing a check or doing one of these conversions, but we want to emphasize the fact that if you make the wrong contribution, or if you employ one of these more advanced techniques like a conversion, it can have pretty expensive consequences if you're not following the right guidelines here. So in our experience, best results happen when we talk about the options with you and mesh your contributions with the other long-term financial and investment plan.
And the other thing is that, back just 2 years ago, it wasn't a big deal. You can convert, and then there was this thing called recharacterization, which the most recent tax bill had killed. Simply not available anymore. And that recharacterization was, I could convert $100,000 today, and next year decide by the time I'm doing my taxes that was a bad idea and put that money back into my IRA. Well, that's gone. You convert it, it's there, you're paying taxes.
So you can no longer recharacterize.
You better plan.
Right. One other piece of housekeeping before we talk about the 3 planning points is this 5-year rule concept that comes along with Roth. So let's clear that up from the get-go.
Yep, we're going to 2 categories.
Yep.
We've got our straight Roth contribution. I take money out of my savings account that I earned, that earned income, and I make a contribution to my Roth IRA. So that amount that's in there now, it's the first time I opened a Roth IRA, I have a 5-year period that I need to keep that money in its place, not distributing the capital gains over that 5-year period. Your contributions you can access within that 5-year period because you've already paid taxes on it, but the gains you cannot.
Okay.
The other is conversion money. Every time I make a conversion, so let's say I made a conversion this year, that starts a 5-year clock. On that one, I can't take my conversion amount or the growth. And next year, let's say I come back and do another conversion, that starts a whole nother 5-year clock. So every time you do that conversion, you are going to be starting that clock over for 5 years. You have to pay attention to that.
And let's be clear here. When we're talking about withdrawing earnings from your Roth IRA, you need to satisfy 2 rules. That account needs to be open for at least 5 years from that first contribution, and you need to be at least 59 and a half to access those earnings penalty and tax-free. You can always access your contributions penalty and tax-free.
Yeah, well, the thing is, if you open that Roth, that's the minute that one starts ticking. So if I open it December 31st of whatever year it is, it's actually as if I had made that contribution on January 1st of that year. So I'm already a year down on this 5-year clock. But I never have to start that clock over for a contribution. So if I make a contribution the following year, I'm 4 years in, and eventually you're beyond it.
So in that vein, let's move ahead and talk about this first planning point of someone who's young, 25 years old. They're in their first high-paying job out of college. Opportunity here to make sure that they're funding their Roth IRA early on because they really probably have the most to gain out of one of these accounts.
Yep.
So let's talk a little bit about why should this particular person care about having a Roth when they potentially already have a 401k from their job. Maybe they're contributing to a traditional IRA. This is just another account for them to juggle. How do you deal with this?
Well, let's think about this. So generations past, not everyone had a 401k available to them once they started into the workforce. Maybe the law hadn't even been passed yet. I mean, and the limits on what you can contribute were significantly less. So someone that's going into the workforce now has maybe on their first year of ordinary contributions to a 401k can be upwards of $19,000 plus whatever the company's matching. If I'm doing that all pre-tax for the next 40 years, I'm not talking about having $1 million IRA. I'm talking about having a $10 million IRA of pre-tax savings. That's if somebody's really maxing out. I'm not saying that that's everybody's
Right.
future dream, but you could create that problem.
Right. So it's essentially, it could be a problem, you're saying.
A bomb.
Okay.
Yeah, a big tax bomb.
That's interesting.
Yeah. So the reason I say that is because at 70.5, all that pre-tax savings has a required distribution that starts. That means the age may change, but the requirement for distributing some of that deferred income's not. So why would I do the Roth? Well, I'm at the lowest tax rates. One, because they're as low as they've ever been right now, with the expectation that thinking forward, they probably would be higher. And also I'm making as least amount of money, I think, at 25 versus what I would expect to make at, let's say, 35 or 45. So maybe I want to take advantage of that 12% tax bracket or 22% tax bracket.
Right. Well, I was going to say, when you're in a lower marginal tax bracket, the benefits of contributing to a traditional IRA or a 401k are slightly diminished. And like you said, the Roth IRA, once it's in there, it's never taxed again. So when you do reach that retirement age, you don't have massive required minimum distributions all from one tax bucket.
Everybody wants to do calculations to figure out whether it makes sense to do Roth versus pre-tax. Let me tell you this. If you're paying less tax now than you would be later, it's better.
You're going to thank yourself.
Yeah.
And so thinking about the end results here for this 25-year-old, really you think about three major tax buckets of where you're able to save your money. We talked about the traditional IRA or 401k and your Roth, but also saving in that taxable bucket, just at a regular investment account, to kind of give you this tax diversity throughout your life. That's where we see a lot of retirees have success, is when they have the flexibility to pull from different tax vehicles.
I'll tell you, it's tough when someone calls and says, hey, I found this car I want to buy. It's $30,000. And I tell them, well, after I take your distribution from your IRA, it's a $40,000 car because we had to pay the taxes.
That's tough.
Yeah.
So they're going to have to wait on that that car there. But so thinking about another consideration here is that a lot of companies are now introducing this idea of traditional and Roth 401k contribution options. How do you think about splitting those up as this type of person?
Yeah, the main thing is you want to be able to save the maximum amount you can. We're not recommending that you save so much that you're now not paying your bills,
right?
And you're creating a debt problem. Because I can tell you, 15 and 20% interest rates on your credit card are pretty hard to compete with when it comes to any tax savings you assume you're making. So pay your bills. But from there, if you have the ability to even split it, you can go 5% to pre-tax and 5% to post-tax. I mean,
build that tax diversity.
Exactly.
Right?
So if you have the option to go that high, one thing that's a no-brainer, and this isn't specifically what this podcast is about, but you're gonna take advantage of that company match. I mean, if they're offering you 5%, I don't care what you need to do. Borrow money from mom. Do what you got to do.
That's free money on the table.
Yeah, that's free money on the table. So you got to, don't go to one less movie.
Yeah.
Do something less each month.
That's a fair point. So I think, again, building that tax diversity, if you're able to split contributions between your Roth and traditional 401k contributions, it's a good move. Another consideration for someone here, a big goal for a lot of folks this age is to buy their first home.
Yeah.
And I know with a Roth IRA, there is a special provision allowing you to pull out money for that first down payment. What do you think of that?
Yeah, I'd say you can do up to $10,000, no penalty. You'd pay taxes on any gains that or if it was an IRA, you pay taxes because it's all pre-tax. But I would say that these are not the vehicles that you're putting money into to try to make that first down payment, because getting money into the Roth is the number one goal. Anything you can keep there, I would hesitate taking any money out.
Yep. The key there is, once it's in the Roth, the longer you leave it untouched, the bigger the benefit is, because once again, it's never taxed again. So if you're able to let that sit until way off into your retirement, traditionally this is the last money we recommend touching in retirement planning. So this is not the money that you should be using for your down payment. Again, that money should be in either a taxable account that's invested conservatively if you need it in the next couple of years, or just a regular savings money market account.
So that's why we focus on, this conversation is all about a 25-year-old,
right,
because this is all about getting money into the Roth.
Exactly.
So, to provide an example here, Andrew, for, how we can help our kids, because I think we are also, on this podcast, not just talking to the 25-year-old who probably doesn't even know how to find this podcast yet. Actually, no, wait, they probably know, but they've avoided it. So it's the parents of the 25-year-old that we may be talking to right now, is that with your planning, as you're working with your estate attorney and your financial advisor and your tax accountant, all important advisors to you, and you're thinking about how you're going to handle your money and pass on wealth to the kids, let me tell you, if you're in a situation where you can help them pay, they tell them they pay their rent, you're going to make sure you give them the money so that you can get it into their 401k. Obviously, they got to direct it out of their 401k account, but you're telling them you're helping them make this contribution to their 401k. $19,000 a year, current limit. Next year, $19,500. It'll keep going up. That's a real way to pass on some wealth. Because how else are you going to get them tax-free growth and tax-free distribution? You can't. Well, we're about to lead into where the 45 and 65-year-olds are. But if you're thinking about it, you can have a very big impact on how your kids think about saving.
Absolutely. And I think you touched on an important point, too, that where a Roth can be a powerful legacy asset. And I think we're going to touch on that here with our second and third planning points. And on that note, sort of transitioning into someone who's 45 to 50 years old, they're in their peak earnings years. This is you, so you better listen up to this section.
This is I'm in. This is you're talking about me now.
So let's talk about this person and remembering that they're in their peak earnings years, and with a Roth IRA, there are some AGI limitations that you might actually bump up against here. So talking about the possibility of how do you contribute to a Roth when you're bumping up those contributions?
Yeah, so if you are working with an employer that has a 401k plan, it's almost a no-brainer that they should have a Roth feature on there. If your company by chance does not immediately knock on the human resources door, don't get yourself fired, but definitely be saying, where is that Roth feature? I think it costs like $250 to file the application.
Because there's no AGI limitation for Roth.
No AGI limitation.
401k contributions.
Exactly. Right. Yes. So if you are bumping into that on your own personal, access to a Roth IRA, first and foremost, definitely look at your options on the 401k plan.
Good point.
You got at 45, you're still dealing with the limits at 19, and we'll be moving on to higher numbers next year. But the other way that you can actually get a contribution in is if you're fortunate enough to not have any money in an IRA, you can actually open an IRA, make a non-deductible contribution. Why would I do that? Well, I'm taking money out of my savings account that's earning me nothing and being taxed on that nothing into an IRA. Well, okay, I get the no, because we didn't take a deduction.
Right, no deduction.
Right, so now what do? We backdoor convert that over to a Roth and not pay any taxes. That's why you hear that terminology, backdoor. It's because it's kind of like feeling like we're kind of skirting the rules, but no, the rules are known. Congress knows what's going on, and they have done nothing to change it. So consider this your way in. Now, however, right, Andrew, we got a potential problem. Is that I've got an IRA.
Yeah.
It's already got money in it.
What if you do have an IRA?
Yeah,
right.
And I've got money in it. Well,
which is likely.
Which is very likely because I had an old past employer and I rolled over my 401k. Well, the IRS looks at your IRAs, even if you have 10 of them at 10 different places. Trust me, you're not hiding your IRA money.
They'll find it.
Yeah, they find it. It's all considered. They consider it one big pool. You can have every different account number on all your IRA money. It's all one pool to the IRS. So if I go and make that non-deductible contribution to my IRA, it's like a drop of water hitting a bucket of water that immediately it's just part of the whole pool.
Yep.
So you think, all right, well, I'm going to go in and convert my after-tax money. Can't do it. It's pro rata. It's now like part of my bigger pool. So if I had $100,000 in there and I drop $6, after tax, and I convert it, well, pretty much 6% of that is a little less.
Right.
Is going to be non-taxable to you. So that would be a conversion through there.
And a potential workaround to this is if your employer offers roll-ins.
Yeah.
Right, from your IRA to get that into that 401k. That's a way to shelter that asset, correct?
Yes, exactly. So if you can possibly get that back into your 401k and free that IRA up to zero balance, you're back to that.
In the backdoor Roth, I know you do a lot of these with your clients, and you're pretty passionate about this. So I think just talking about why you're passionate about this.
Yeah, so it's like one of the quickest ways to save people money. So you in this way, we don't want to just justify ourselves by getting you an extra 100th of a % return on your investments, which is nice when that happens. but we want to be able to make sure that you are setting yourself up to be extremely efficient. So, I mean, the importance of getting money into a Roth is that tax-free growth, that tax-free distribution, to know that you're in a position to be able to take money and not have to worry about everything being an additional tax bill, and setting up your family long-term for tax-free distributions. That's just smart.
Right. Why not do it?
Yep.
And so moving ahead here to our third planning point. So let's say now you're 65 years old, you're about to retire. I know this will probably resonate with a lot of our listeners, so I think this is an important one. Thinking about, so let's say you've been contributing through your 20s and your 30s, you've done some backdoor Roth, so you've done a great job of building up this Roth base, but maybe you have some other opportunities here to continue to build up that Roth, even if you stop working, because remember, you need earned income to contribute to that Roth. But Roth conversions, this is where this becomes a popular planning topic.
Big deal. I mean, unless you're in your 40s and 50s, so which we were talking about before, and you transition a job and have a 12-month period where you're not making any money, the Roth conversion is a pretty tough one to swallow because you got to come up with the cash to pay the taxes. Well, when you're in retirement, if I'm 65 years old, I haven't turned on my Social Security yet. I don't have to. I would actually probably recommend that you don't. You don't have any required distributions. Ideally, you did that after tax, savings that you were talking about, having a nice sized brokerage account. Pay taxes on interest, dividends, and cap gains. But when I want to take out money, I've got something I can access. Think about that age 66, you've just retired, you're happy as ever been, and your advisor turns around and says, hey, let's convert $150,000 of your IRA and create some taxable income. You're like, are you crazy?
I've heard you say this before.
Well, the reason I'm saying that is because you could literally be converting money at a 12 or 10 or 12 and 22% tax bracket that you would otherwise lose. So let's say you don't do any of that, you didn't pay any taxes, then age 70 rolls around, turn on Social Security, turn on your IRA distributions. Next thing you know, you're paying 30% in taxes, and you're like, how did this happen?
Yeah. So this is powerful, and I think not enough people are talking about this one, because if you're able to successfully convert some Roth assets here, you're lessening your required minimum distributions, and you're also creating a really powerful legacy asset. So you're doing a big favor to your heirs if you continue to build up this Roth IRA, and talk a little bit about that.
Yeah, so if I'm converting money at these extremely low tax brackets, no matter where I'm at, maybe I'm lucky enough to be in the 12 still when I get there, or the 22. You at a bare minimum, we're talking with the accountants and saying, hey, let's max out that
Take
bracket.
It to the top of that bracket.
But you may have extremely successful children who are in the 35% tax bracket, and you giving them a bunch of IRA money beyond your own needs. I mean, let's feel sorry for everybody here that's inheriting money, but put it in its proper place. This is where the planning side is. You don't have to. You can pay all the taxes you owe. We just can pay them at a lower rate.
Right.
And I can pay them at a lower rate than my kids will. And then it'll be better for my grandkids.
Because a traditional IRA really isn't a friendly asset to inherit from a tax perspective.
That's right.
For the reason you just said.
Yeah. You're inheriting every untaxed dollar that goes with it. Now, you're under current tax law, it's still favorable to do that because you get to distribute it at life expectancy of the beneficiary, who may be 40 or 50. But if the tax rules change, that could actually become a significantly larger liability, which there is a bill out there, the Secure Act. We may or may not hear more about that in the future. But if you haven't heard about it, it does impact how required distributions will be handled.
We recorded this podcast in November 2019, and since then, the Secure Act has become law. Now, as Rick mentioned, that law did overhaul the rules for beneficiaries of retirement accounts. So with a few exceptions around chronically ill or disabled individuals, non-spouse beneficiaries no longer have the ability to do what is called a lifetime stretch. So retirement accounts now must be emptied by December 31st of the 10th year following the year of death. As a result, passing on a large traditional IRA to a non-spouse beneficiary presents a larger tax burden than before, as the ability to spread those tax hits from the distributions over a lifetime has gone away. So as a result, Roth IRAs are even more powerful as a legacy asset, since there are no taxes on those distributions for heirs, even though it still needs to be distributed within 10 years. Now, back to the episode.
I think the opportunity here is working with your professionals as part of your estate plan, as part of your smart tax planning with your advisor to make sure your investments are growing at a proper rate and all of these things are being tied together, especially in the case of advisor investments where we're working with our clients as a wealth advisor with the financial planning and working with your other professionals. I mean, this is just a no-brainer.
Absolutely. And I was about to say the same exact thing, is that the conversion strategy is a little bit more advanced. We don't recommend doing this on your own.
Yeah, none of this stuff.
Yeah.
Really, basically down to your simple Roth IRA contribution.
Exactly. Work with us, work with your CPA, and we'd love to work with your CPA as well to make sure it's meshing with your entire financial plan.
Yeah, if you convert incorrectly and make a wrong contribution, let's go down to the simple thing. If you make the wrong contribution and you found out you weren't allowed to make the contributions, there are penalties to pay. And those are not friendly penalties because you may not have made any money and you're still paying those penalties.
Exactly. You don't want to get the IRS angry.
Don't do it.
So, Rick, this has been a fantastic conversation. I'm really glad that we finally got the opportunity to do this. I know you were very excited about it.
I know. I'm going to be dancing through the office. Roth, yeah. Listen to the Roth.
Rick Roth Winters.
Yes.
That's it. So before we wrap up here, I want to go through a few of our big takeaways from our podcast here. I think for me, a couple that resonated. One is build that tax diversity throughout your life. The Roth is a powerful retirement savings vehicle, yes, but so are your traditional IRAs and your just regular taxable brokerage accounts. So building that up throughout your working career gives you flexibility when you're retired to pull from multiple accounts. And then the other, just how powerful an asset the Roth IRA is from a legacy standpoint. Your heirs cannot inherit a friendlier asset from a tax perspective than the Roth. So I think those for me really stick out. How about you?
Yeah, I'd say don't miss out on maximizing your contributions. Know where you can get in.
Right.
Don't shy away from exploring your ways to get into a Roth. And don't. I hate to be the don't guy, but make sure that this is the do. Make sure you consult with your tax advisors and your other professionals to get it right.
It's a great point. Because like you said, the penalties can be pretty nasty if you don't.
That's right.
So this has been Andrew Busa and Rick Winters from Advisor Investments thanking you for listening to the Advisor You Can Talk To podcast. If you enjoyed this conversation, please subscribe and review our show. You can also check us out at www.advisorinvestments.com/podcasts. Your feedback is always welcome, and if you have any questions or topics that you'd like us to explore, please email us at info@advisorinvestments.com. Thanks again.